Hey everyone, welcome back to the channel. In my most current trade for NVDA, I am down 200%. If you trade, you know that stop losses are very important. And how did I make this mistake of not putting a stop loss? Today is an opportunity that I can show you when a trade goes against you, what are the different options that you can employ to salvage that trade. If you end up learning from this video or just enjoyed the video, consider subscribing, consider sharing with your friends and family, and without further ado, let's dive in. At the time of this recording, the markets are closed. It's about 9:28 a.m. So in 2 minutes, the market will open and we will start to see some movements on the price for NVIDIA. NVIDIA did dip in pre-market. We are down from 108 to now 103. So I talked about how I was down 200% on a trade. I think I'm going to be down even more than this. Right before the earnings, which was on 8/28, we were trading somewhere in this range of 125 to 127. The market just opened up and the stock is currently trading 105. Seems like we do have this gap down since the close of yesterday. So we may be able to see some gap filling happening throughout today's trading day. Now the question is, how did I get myself into this hole? So let's go back in the history a little bit. So on August 29th, when NVIDIA just reported earnings on 28th, the next day I posted this somewhere around noon time frame. And I said, overall I'm happy with the earnings trade of NVIDIA. Here's a risk management lesson. If you are selling multiple contracts spread across different strike prices, and I put all my trades of NVIDIA for the earnings. So here's my first trade. It was for August 30th, NVIDIA 120 put. And at that point in time, I was up almost 70%. The other one was 121 put. I was up 76%. Then I was 125 put, same expiration. I was up 30%. And then this was 110 put. I was up almost 99%. And 120 put, this is 33%. Out of all these trades, I closed all of them except one. Why? Because most of these trades, look at this trade, August 30th, August 30th, and August 30th, except this trade, which was expiring this week. And we had only captured 33% of the premium, 60 or so premium. So I decided to leave the contract open. And now because of that, as of yesterday, September 3rd, I was down 205% on this contract. See, on that day, the contract value was 2.74. Today, the end of yesterday, the contract value was 1250, and right as the market opened, because we had a gap down, the contract value has gone up to 1425. So now I'm down 248%. This is a very good example to show why options is such a leveraged vehicle, and you have to be very careful on how you manage your trade. Back in May of 2024, I made this video called Master the Wheel, 8 Proven Principles for Picking Winning Stocks. Go ahead and watch this video if you trade options, especially if you are option seller who generates income on a weekly, bi-weekly, monthly basis. If this is your primary strategy, I highly recommend you go watch this video. First principle is know the stock. In our scenario, we are looking at a stock called NVIDIA, which is part of the Max 7. And right now, this is the best AI play in the market from an AI infrastructure standpoint. The point is, now because we are down in this trade, there are two ways we can manage this trade. Number one is we're going to roll this option, and I'm going to touch upon that a little bit later. The second option is we go ahead and we close this contract, which means that we will have to buy this contract out. We will have to pay $1,425, which means that I will be in a loss of $1,000. Let me first talk about this option is off the table for me in this trade, because first of all, NVIDIA stock decline is temporary in nature. I was planning to buy the stock at 120 and I got a premium of 409. So let's say, so 120 minus 409, we are looking at 115. Let's say $116 is what you would have bought this stock for. Right now, the stock is down to 104, 105. That you're down $11, $12 currently from your strike price. Even if I own this stock at 115, does it matter for me if I can hold this stock for, let's say, a month or 2 months or 3 months? Would the stock price be up in the mid to long term? Yes, absolutely. This is the reason why you want to buy stocks, high quality stocks, when you're trading wheel strategy, because you do not mind owning the stock. Because if you pay $1,000 to close this contract, you're $1,000 in a hole. Whereas if you buy the stock price at $115, $116, you will own 100 stocks of NVIDIA. So that is the reason why option 2 is off the table for me in this particular trade. It does not mean that this is going to be a true strategy in every single trade. This particular trade, yes, it's off the table. So let's go back to option 1. If we go ahead and roll this contract to a further date, how much we are going to make? So if we roll this contract to October 4th, 30 days out, and at the same price of 120, we will get somewhere, let's say 1680 is what we will get. So if we subtract 1680 with the current price of 1425, you get about 256. So from $116, we deduct 256 additional. So you're looking at about 113.5. So what you're doing is you're reducing the cost basis of the stock that you will own, and you also are giving enough time for the NVIDIA stock to come up. What you have to keep in mind is when you are doing these kind of trades, if there is a very big difference between the current stock price and your strike price, so let's say if it's down $30 or $25, just a hypothetical scenario, the stock might get assigned to you. So before the stock gets assigned to you, you should make that call. And also don't wait for the last trading day to make the rolling, because a lot of times brokerage firms like Robinhood and others, they are going to assign you the stocks early. Now I'm on Fidelity right now. They generally don't do that, but again, there is an offside chance that that stock might get assigned to you. 2 or 3 trading days, you should definitely look into rolling options if that is the route you want to take. So in summary, whenever option selling goes against you, these are the 2 main options that you have. Either you close the contract or you can roll the contract. In most cases, I employ rolling the contract further. The downside of rolling is that it blocks your capital for a much longer time. However, if that contract gets exercised, your capital will be blocked anyways. If you are an option seller, how do you manage your trades that go against you? Let me know in the comments. I would love to learn more. Did you enjoy today's video? If you did, make sure to give us a like, click on subscribe, and ring the bell notification. I will see you next time, investor family, but don't forget to invest for tomorrow.